I'll tell you what, we do have some recession warning signs that are flashing red and have been flashing red. We're going to be talking about that in today's video. I'm going to be showing some really cool charts today and getting into the S&P 500, etc. You're probably wondering why I have Meet Kevin on here. Well, it's funny because Meet Kevin's been getting a lot of flack ever since he came out and said that he's selling everything, getting out of the markets, and some real estate. And, you know, a lot of people look at that like a flip-flopper, that he's very uncertain because he's been saying one thing and then now he's doing another. Let me just tell you something, just give you a different perspective. From a trader's point of view, and sometimes even an investor's point of view, if you're not willing to adapt in a certain market environment, you're going to get destroyed at some point. That is what happens. You need to be able to adapt in any environment. Now, the thing is, being able to adapt and change quickly is a very strong personality trait. However, from the outside looking in, it looks like a lot of uncertainty. And you can see that with the comments being flooded his way. You can tell he's pretty emotional about it. If you go to his channel, just give him some words of encouragement. I tell you what, I had to tune in just to see what he was saying. But earlier in the day, he talked about the CPI data, and the market at that time was ripping, right? And now we looked at that. We looked at where the market was going to basically either open up or touch down at, and it hit those levels, which we'll get into, and it started ripping from those levels. So he seemed a little off in this video, but then by the end of the day, the market sells off and he's super excited. And then even in this one, he talks to flip-flopping again, back and forth. It was just interesting stuff. But it's an emotional roller coaster, and he's sticking to his gun. So, you know, I gotten to meet him before in person. He seemed pretty nice. That's us right in front of the Capitol. He was doing a live stream out there. But yeah, if you ever watch his stuff, just give him some words of encouragement, because he's been just getting brutally just annihilated in the comments section. I just wanted to say that really quick. You're watching the Stock Market Brief Show. My name is Michael Silva. Today's date is February 10th, 2022. Let's go ahead and hop into today's episode. All right, everybody, welcome back. Okay, so first and foremost, we did get our CPI data today, and it did shake up the markets quite a bit. It came in at 7.5%. Now, consensus was 7.3. Now, I'm not going to go too much into the details of the report. Because I know most people already know, but if you want to screenshot this and then read over it, this is from a source from the U.S. Bureau of Labor Statistics. You can see the individual stuff that really help increase the CPI report. I'm more interested to see how the market and how the order flow interprets the data. And as you can see here, the SPY, what a wild day, right? We gapped way down, and then we just started ripping. Just everyone was thrown off by that as we came into this area, and then we came down a little bit and started moving up, and then started selling off. Why did we sell off very hard? Well, it's because of Fed Bullard's comments. Fed Bullard came out and said, basically looking at a large and fast interest rate hike for the Fed, and that he's in support of. And, you know, I don't know if this is just, why is this necessary? But just one comment comes out and the market completely and obliterately rolls over. So, you know, just wild how one comment can do this. Now, the Qs, also very similar. I want to call this out because a lot of people may have not have caught this. The Qs actually put in a high, and it came in and touched this high too. Very similar to SPY. But as you know, these are cap-weighted indexes. So if you were paying attention to the big dogs of tech, Apple, look at what happened in Apple. We got that move up, but notice how Apple never came back up to the previous high right over here. That right there was a warning shot that I was looking at intraday. Microsoft, same thing. So we had two big dogs of tech giving us a little bit of a warning sign that there could be some further downside. If you take a look at the market dashboard, you can see everything was in the red, down pretty severely on the day. A lot of volatility overall. A very mixed day too, right? So even like utilities, for example, is a more defensive sector. They were towards the bottom. Real estate, I mean, these are rate sensitive, and we're going to talk about yields here momentarily, but more cyclical names up there at the top. Consumer staples is defensive, and that was in the top 4, but still down 1%. If you take a look at the heat map, yeah, pretty severely down, right? A lot of red on the day, couple pops of green in there, but you know, like Disney reported earnings and shot up after hours. That was actually one trade that we were looking at in the Discord. It's basically all red. There's nothing really to report here, okay? Now, this is where it gets interesting, is what took place with the yields. Now, we talked about there's probably going to be some strong move in the yield curve spread. And the reason why I talked about Meet Kevin is because he is thinking that there's going to be a recession, right? But they were talking about it, and other YouTubers were talking about it in the terms of CPI data over 5% typically leads to a recession. And it's not that they're wrong, but there are definitely other factors. And one of the great leading indicators is the yield curve. And the one that we like to look at is 10s and 2s. It's a more popular one, right? It's a one that a lot of people track. Also 30 and 5 too as well. Today, obviously, with the CPI data, there is a very big move to the downside. I think it was at 0.58 or 0.52 yesterday, and now it's at 0.42. So getting very close to an inversion. Hasn't been there for quite some time. And same with the 30 and 5. Now, interestingly enough, today, intraday, the 7 and the 10-year yield inverted. Now, that is a more mild inversion, but it's still worth noting. They closed the day, 10-year, 2.03, 7-year, 2.03. You can see these things are contracting very, very tight. And when they contract, this basically means that they're flattening out. The curve is flattening out. So the Fed is going to have to do something here. Now, this is where it gets very interesting, okay? If you take a look, this is the 10 and 2 spread. I just flipped it upside down on its face. So anytime that it gets to 1.0, that is the inversion, okay? And as you can see here, we are heading obviously pretty much straight north to inversion. We're not there yet, and we could pull back. I don't know, right, at this particular point in time. And every time we inverted, right, it led to a recession. And I'll show you, the recession didn't happen during the inversion. It happens a little bit after the inversion. Okay, so it's hard to determine. I mean, sometimes it can take a year, 2 years. But what's interesting to note here on this is that every time they inverted, if you look at the gray shaded area and you're like, what's that? Well, that's the Fed fund rate. That's what they're talking about right now, about raising. Now, understand, each inversion that happened, okay, it happened really while rates were being raised. So it gave them the room to lower rates when we had those yield curve inversions, all right? Bam. And that helped basically get us out of that recession, right? You know, flood the market with cheap money. What's different now? Well, we're sitting at a time where the yield curve is very close to inversion. Actually, I looked at all the data that I have on stock charts. I can't tell you if this is a forever type scenario, but dating, I think I went back, you know, I think it was like 60 years of data, and then it kind of cut off. We've never had interest rates this low at this close to an inversion. So this is obviously, this time is a lot different. Now, if we start inverting, what's the Fed going to do if we can't actually lower rates? Are they like what tools do they have? I don't know. I don't have that answer. I'm not an economist, but what I am pointing out is some data. When we invert, we typically get an inversion, or when we invert, when we get that inversion, we typically have a recession later. And to get out of that recession, you typically see the Fed fund rate go back down to zero and just get crushed down. Not all the way to zero in all cases, but that has been the case. So if we get an inversion and we get into a recession, are the money printers, are they going to just start screaming back on? I don't know. I can't tell you. But it seems to me that, yes, we are getting into the jaws of a potential recession. And it seems like they're pinned in a very tight pickle right here, obviously. Because, you're stepping into an environment of slowing growth, in raising and hiring inflation. Rates are already at zero, and we have a curve that's potentially going to be inverting. So raising rates into a slowing economy, it's just a recipe for disaster right here. So what do we need to do? It's very hard to determine what to do because if you hold cash in a bank account, and inflation continues to go out of control, your purchasing power is obviously it decelerates significantly. Maybe for another video, we'll talk about different scenarios and kind of brainstorm what we can do. Now, if I keep going on this list, I want to show you, once again, the 10 and 2. Now it's flipped back over, right? So it's 0.0. When it gets below that, that's inversion. And you can see here, right, inverted, 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 inverted. So those 4 times are the same times that I just showed you on this chart, right? 1, 2, 3, 4. Okay, so we'll go back 1, 2, 3, 4. And then you can see the gray dashed areas right here. Those are recessions. Okay, it even surprisingly got the COVID pandemic recession. Maybe that's the reason why. Maybe that's not. I don't know, right? But we got an inversion. We got a recession. Or maybe that wasn't the recession that this inversion was coming from. Maybe it's going to be another one. Who knows? Or we get another inversion. But the point here is I want to call out that when we get the inversion, it can be multiple years before we're actually labeled in a recession. All right, like we got this inversion here around 2006, and it wasn't until later where we hit that financial crisis. And then also, the 1990s recession, it inverted here in the 80s, but then years later, it obviously went to a recession. So this is not something that just like, how do I say this? It's not something that just like, okay, we inverted, we're going into recession, bear market, everything crashes. That's not necessarily true. And I want to reiterate that because a lot of things could potentially scare people out of the markets, but there's always going to be opportunities from a long perspective and a short perspective. Okay. Now keep in mind here, when we inverted, actually, we got a little inversion here before the dot-com kind of blew up, and understand that the markets during that sell-off around this time, actually, the markets went a lot higher, right? We had a pretty significant sell-off, but then they melted up even further, and then we had that dot-com just burst. So you look at the market is looking weak overall, but we don't have for sure answers, and we'll talk about those levels here. Now, this isn't the only thing that causes recessions or causes the Fed to raise rate hikes. A long time ago, I posted this. This was from December 2020, and I want to just repoint it out. I talked about just notice how strong moves in oil preceded stock market values dropping. Strong moves, right? So WTIC looks like it can pop to 70 rather quickly here. This is me talking about oil, at around 45 or something like that. Oh, it was at 50. Saying that it can pop up to 70, and a lot of people probably thought that was pretty crazy back then, but now oil's at $90. But understand that each time that oil made a huge run, we did see what preceded was a market sell-off. Okay, big move, market sell-off, big move, market sell-off, big move, market sell-off, and now we're obviously getting oil prices significantly higher, and they've been rising, and I'll show you a chart here momentarily. But another note is, just to kind of reiterate this with some facts, rising oil prices has contributed to the last 40 years of recessions. So rising oils also contributed to the stock market peaks resulting in bear markets. 1973, the Arab oil embargo, 1987 stock market crash, 1990, 1994, and 2000. So oil can force the Fed to raise rates. And what are we seeing happen? We're seeing energy prices, CPI go higher, really led by energy, and oil prices have been absolutely skyrocketing, right? We were talking about that post was at 50. We're now right around 90. Trust me, it can go higher. It doesn't mean that this is the point in time where it's going to fall apart, right? Some people are calling for $300 oil prices. So we'll see. I do notice that on a weekly time frame, we broke out of this pattern, we backtested it, we backtested again, and now we're kind of hitting this upper trend line of this broadening wedge pattern. So maybe it does take a little bit of a breather here soon, but we don't know yet at this particular point in time. Now, another thing to call out is typically when you get market tops, the top performing sector is typically energy. And what is doing tremendously well right now? What is really the only performing sector year to date? It's XLE. It's energy, right? And they've been ripping. Now, that is typically a sign of a potential market top. Now, we don't know how high tops can go, so we need to be very cognizant of that because trust me, this market can go higher. It's very possible, and we cannot rule that out because if you just say that's not going to happen and then it happens, you're going to have missed opportunity. All right. But also on the other side of that, you got to be very careful because the market is obviously very volatile right now and it can obviously go down further. Now, what is something else to call out right here at around market tops? Consumer staples and utilities start performing. What are you noticing with consumer staples? Consumer staples is performing very well relative to the SPY. All right, it's actually been doing very good from a rate of change perspective too as well. And that was one of the sectors that I've been keeping a very close eye on that was leading into 2022. So consumer staples and utilities here. Utilities was one of the worst performing sectors today, and that could be because of the move in the rates. They're rate sensitive. So we'll see how they perform here coming up. But those could be some sectors to very well keep a very, very close eye on here in 2022, going into Q2 of 2022. All right, now let's continue on to the S&P 500, and we're going to talk about today's price action and what to expect going into the end of the week. So first and foremost, this is the weekly risk range. We're right there back in the center. So there was a lot of movement, and we're right back there pretty much in the middle. All right, very volatile, but we're right back there. Now, what happened today? We had a gap down on the CPI data. Move was right around here, and then we saw that market run straight up. And now we talked about yesterday, hey, be careful if we get the gap fill, understand that there's still more risk to the downside than there is reward to the upside. And that was talk about one big fake out right there, that big strong move out of the gates, and then it was completely reverted, closing below the low of the open, which is a nasty looking candle. Somebody pointed out today, this was hilarious actually on my Discord. He said it was a smiley face with a teardrop, which it's true. And I want to be cognizant because I know that people lost money in this environment. This is a very volatile environment that you need to be very careful. So hopefully you hear me when I say that, and I've been saying that. I mean, what happened? Oh my gosh, like Affirm today, AFRM or something like that. It looked hecka good, but guess what? It was like the weirdest pump and dump thing that happened. You had them reported earnings and they posted it early on Twitter. It was like a leak it all sounds like a scam. It was so awkward. They halted 3 times when the real data came out and they dumped. I don't know. It was just disgusting. Not only that, but also Uber. Uber also halted for some stock news and then just dumped. Very weird, very strange market. You need to be on guard, to say the least, is what I'm trying to say. Tomorrow's risk range, 455 to the up end, 445 slightly below that to the downside. So basically, it looks like to me that it's going to be finishing with its weekly range. So I'd expect some volatility here back and forth. But that's a big range of volatility, so be mindful of that. It was a pretty aggressive move, sell-off to into the close. And if you take a look here, you can see we kind of got a little bit overbought and we just drizzled off throughout the rest of the day. It could be potentially wedging right here. So if we get some sort of relief move, look at 455 to 460 for a potential area for resistance. All right. And if we start heading down further, this risk range brings us right down to this previous resistance and this previous support. So right under 445 could be a bounce point too. I don't see a strong setup at this particular point in time. It doesn't seem as clear to me as it did yesterday, excuse me, and the day prior. So just be very careful that there is going to be a lot of volatility packed in tomorrow's trading session. If we take a look at the Qs, looks very similar. It looks weaker, obviously, than the SPY did. And you can understand here that was a pretty big volume day on this data. This could very well be that bear flag forming. It's still early to tell, right? Under 355 and just under 365 is the risk range on the Qs. Now, on the 15-minute time frame, we do have this gap still above us, right? We're getting a little overextended here on the 15-minute time frame. Does also potentially look like it could be wedging here as the 5-day moving average is rather flat and the price is just slightly there below it. Wait for this to start turning up potentially and then start trying to get back above zero. If that happens when we're lower, especially down in this range, that could be a good sign. I mean, that would be something that I might try to play intraday for a bounce. But right now, honestly, it's a very, very difficult environment to navigate as price hasn't really given us too much data. It hasn't consolidated and volatility is very high. Tomorrow's Friday, okay? Understand, if you want to have a good weekend, don't go all crazy willy-nilly into a Friday and then have to sit out for a couple of days. So if you want to enjoy your weekend, just take it easy. That's all I got for you, everybody, on today's video. Hope that helps out. I don't really have much to conclude here at this particular point in time. Hope you enjoyed. Hope it helped. And I will see you all back here tomorrow.